Good evening. Today is September the 27th. We are on the MSA SBTRC 2022 Atlanta Bonding Education Program, ATL BEP, Module 2, Construction Accounting and Financial Management. Mr. Josh Roper, CPA, will be our presenter, partner at the Altruis CPAs LLC. Okay. Our agenda here is Mr. Joe Jackson, our Executive Director, will do the welcome. I will do the roll call. Mr. Roper will do the construction accounting presentation. We will have a question and an answer session, homework assignment, close it and survey, and then we'll have a 10 minutes break, about an hour in. And Mr. Joe Jackson can begin.
Great. Thank you very much, Beth, and all who's joining us. I hope everyone's having a great Tuesday in this nice fall weather. And I heard folks talking earlier about the unfortunate hurricane that's basically scheduled to hit land. So I hope if you have any family members in the pathway, everyone will be safe. And we hope and pray that we will not get much of this. So definitely keep everyone in our prayers. So once again, I spoke to Beth and she said you guys had a great class last week. Unfortunately, I was out of town in DC having some meetings with the Office of the Secretaries, of which you guys will hear much more about that as we proceed during the class schedule. But I will share with you a lot of great, awesome things are taking place with the DBE program. So, as we begin the class, we share it with you guys to definitely make sure that as a business owner and the individual has the most interest in your company, we want you to make sure that you fill out a to-do list from the beginning of the class, starting with safety last week, throughout the remainder of the class. I really want you to fill out a to-do list as you go through the classes. And once we're done, when we begin to meet with you one-on-one, I really want to see your to-do list, and we want to make sure that we provide you with the prescriptive plan. And speaking of planning, with any construction company or any business, you need a great CPA, and you need to make sure that your accounting and your business financing is definitely in order. Tonight, we have a CPA who you will hear and you will learn a lot from. Josh is the founding partner. Josh Roper, CPA, is the founding partner of Altruis and currently serves as the firm's managing partner. Josh has been in the public accounting sector for over 20 years, working for firms ranging from local to Big Four, and also spent time as a corporate controller for a construction company. He specializes in providing attest, accounting, consulting, and income tax services to privately held businesses, not-for-profit organizations, and individuals. During Josh's career, he has worked with companies in a variety of industry, including manufacturing, distributing, retail, nonprofit, professional services, but he specializes in the construction industry. Josh has a wealth of experience in both the public and private sector dealing with accounting. It allows him to provide a comprehensive approach to serving his clients that extends beyond the traditional accounting services that enhance internal controls, improve process efficiencies, and maximize company financial performance. He is passionate about his clients and looks for every opportunity to help them reach their business and personal goals, and accomplishes this by listening to his clients, being very proactive, and providing superior service. Josh received his bachelor's degree from Western Carolina University with a concentration in accounting, corporate finance, and personal financial planning. Graduating in the top of his class, receiving the top honor of magna cum laude honors. His professional affiliations include American Institute of Certified Public Accountants, AICPA, Georgia Society of Certified Public Accountants, GSCPA, and most importantly, the Construction Financial Managers Association, CFMA. Ladies and gentlemen, be prepared to gain a lot of knowledge. Josh, thank you very much and welcome. We'll turn it over to you.
Thank you, Joe. Thank you very much. Thank you for being here. Do we need to switch or? Okay, hold on. Give me just a second. We'll do some shares. All right, we're all good then. Great. Thank you very much. Welcome, everyone. Again, my name is Josh Roper. I'm a CPA. I have a firm in Atlanta right across the street from the Brave Stadium, Altruis CPAs. We are a traditional CPA firm serving closely held businesses. I specialize in construction. So my part of the practice is probably 95% dealing with construction contractors. That means GCs, subcontractors, specialty contractors, architects, engineers, basically anybody within the industry I like to serve kind of in a comprehensive manner. We provide a test that means audits, reviews, compilations, consulting, whether that be accounting, job costing, estimating, CFO services, helping you with your banking contacts, surety contacts, and then tax services. We take a comprehensive approach and make sure that all of the income tax, I think there's someone in the waiting room, all of the income tax obligations and liabilities are met as well. This is my 23rd year in construction accounting. I spent 3.5 years as a controller for a large general contractor. I think by the time I left, we were about $150 million. And then the rest of the time I've spent in public accounting, basically doing audits and tax returns and serving other construction companies. So I had a great job. I had a great time as a controller. It was a really wonderful experience because I spent so much of my career on the outside looking in. It gave me an opportunity to get on the inside and see it from a different perspective. But, you know, after 3.5 years, I decided instead of servicing one construction company, I wanted to go out and help a bunch. So I came back out of the construction controller position into accounting, went to a big firm. And then about a year after that, I just launched my own. I'm past president for 2 years of the Construction Management Financial Association. I'm going to tell you a little bit more about that. That's Atlanta's leading chapter for construction financial managers. Its sole purpose is educating people in the construction industry regarding the financial and accounting aspects of it. And again, 95% of my clients are in the construction industry. So just to kind of give you an overview, or, you know, kind of go through the agenda of what we're going to talk about tonight. And I'm going to kind of bounce around and talk conceptually, right? There's no way I can teach you how to do construction accounting. I'm going to teach you from a theoretical basis of what to look for and how to kind of, you know, strengthen what you've already got going on. So we're going to go over a brief overview of construction accounting. We're going to briefly talk about estimating and job costing. Job costing is the most important part of construction accounting, but you can't talk about job costing without talking about estimating first. Because when you look at the construction industry and I say point to the single most important number in a construction contractor's financials, it's going to be the estimate that they're the current estimate for their next job, right? So each contractor is only as good as their current estimate. Then we're going to go into some accounting methods. It's not always black and white. Then we're going to kind of talk about some of the contract schedules. I'm going to show you some financial reporting. Then I'm going to give you some tips for some best practices, and then we'll open up the floor for questions. Does that sound okay? All right, so let's talk about the overview of construction accounting. So normal businesses, right? Revenue is recognized when businesses earn. I'm your CPA. I do your tax return. All right. Then once your tax return is complete, I have earned my money because I completed the service I was going to provide to you. So I'm going to send you a bill. So that's the world, right? Is revenue is recognized when earns. You have typical accounts receivable and payables. People owe you money, you owe people money. And then operating activity is the sum of all your transactions. So for me and my CPA firm, the sum of all my total revenue is how many tax returns and audits I do, right? In construction, it's not quite like that. Your revenue is a calculated amount. in some instances on the percentage of completion. You have accounts receivable and payable, but you also have a portion of accounts receivable and payable that are called retainage. And so what a lot of companies do is they say, okay, we're going to give you $100,000 job, and we're going to allow you to bill us for that $100,000, but we're going to withhold 10% of that job as retainage until the job's complete. We make sure all the punch list items are done. You did what you said you were going to do. And then at the end of that job, we'll release that retainage. And then operating activity is determined based on the outcomes of the sum of all the projects. All right. I'm going to keep reiterating that, right? So again, in your normal businesses, it's sales. In construction, it's all about the projects. All right, so let's talk about estimating and job costing. So there's a symbiotic relationship, right? So you can't go in and estimate one way and job cost another way. As I said earlier, estimating is the most important number in construction. It represents the total cost to complete the project, including the total cost incurred plus the total cost to complete. Details project functions and related costs, and is an ongoing process. So once you do an estimate to go bid on a job, that's not the only time you're going to estimate that job. Your goal is to estimate that job on an ongoing basis to make sure that the operations and the costs stay within your estimate. An estimate can include change orders and whatnot. Job costing, the primary purpose is to capture project costs to compare to the estimates. Plain and simple. We do an estimate and we say, okay, it's going to cost us this much to do the job. All right, so that's our estimate. Then as we incur cost on that job, we're going to job cost it by our line items on our estimates. So if I budget for a project manager in my estimate, or if I budget for concrete in my estimate, then I should have a job cost for those particular items. All right. It's not a one-to-one, but for our argument's sake, for this presentation, it will be. Okay. So you want to make sure that your estimating form and your job costing structure, they don't necessarily have to mirror each other, but they need to be very closely aligned. Okay. Because that's how you get your job performance, is how well did my actual job cost come out to my estimate. Should be in real time as reasonably possible, right? Back in the old days, it was much more difficult to get real time, but with integrated systems and everything, it's a little easier. And then it should include all project related costs. And we'll talk about that a little further in a minute. All right, so let's talk about job costing. So you don't have, so where do I start with job costing, right? So the Construction Specifications Institute issues what's called the master format of cost codes, right? So, depending on what software you're using, they generally have inherent cost codes, whether it be QuickBooks or some other software. But there is a standard construction industry cost code that you can use out there to be able to set up your job cost accordingly. Again, we talked about it should mirror the estimate. So let's talk, and so one estimating format per company, right? So I've worked in a company where they had 3 different estimating spreadsheets, right? So, and then they give that back to accounting, and then you've got to convert those estimates into job costs at 3 different levels. So then that becomes a project in itself. So as a company, if you have multiple people doing estimates, you guys need to sit down and say, okay, there's only going to be one way we're going to estimate our jobs, and then everybody goes out and does the estimates the same way. So that way, when the cost starts coming in, they can be job cost accordingly, and everybody's comparing apples and apples along the way. Does that make sense? All right. So again, the entire purpose of job costing is to provide a comparison to the estimate. It provides clear budget management. So as you're going through, if I estimated $100 for concrete and I'm at $105 for concrete, what's gone wrong, right? So the way that I look at it is, when you go over budget, you can look at it one of 2 ways. I had a cost overrun, okay, and then you want to say, why did I have that cost overrun? Or maybe I have an opportunity for a change order, right? I did some extra work and I go through and I say, well, they gave us approval to move through. That's why our cost overrun. Let's go back and send them another bill. So it always provides a clear our budget management. It should include direct costs and indirect costs. I'll talk a little bit more about that in a minute. And then again, we want to maintain it in real time. So let's talk about direct versus indirect cost. All right. So I've sat in restaurants, I've sat at bars, I've gone to conferences, I talk with a bunch of people in construction industry, and I hear all people in trade industry say, oh, my gross margin is 10%. Oh, my gross profit, gross margin interchangeable. Oh, my gross margin is 20%. Oh, my gross margin is 40%. And I say, well, what industry you're in? They go, well, I'm a roofer. And I said, well, your gross margin is not 40%. And they go, oh, yes, it is. I go, you don't do anything differently than any other company. I promise you it's not. And what happens is people have a misconception of gross margin, right? So there are two parts to a job. And if you all have businesses, right? So conceptually, when I'm going out and bidding a job, I have direct cost. I'm going to go out and I build a house. How much is the lumber? How much is the plumbing? How much is the electricity? How much is the land? How much is the landscaping, right? How much am I going to pay my project managers? How much labor dollars do I need? These are all costs that are going to go directly to the job that you're working on. They're very easily identifiable, and it's a one-to-one ratio, right? I'm hiring you or I'm purchasing this for this job, all right? Now, those are direct costs, but you as a business owner, as you're running your company, you have a lot of costs that you incur that you can't identify to one particular job, right? So here's some examples that I have out. Insurance, we have general liability, right? Errors and omissions, right? So we look at these and we say, okay, yeah, we are doing job costs for errors and omissions and we're incurring costs for general liability. We couldn't run our company without it because we're required to have it. And any expense that we make is related to a job. So that's what's called an indirect job cost. Does that make sense? Depreciation. You got trucks that you drive around to the jobs, right? You don't want to say, well, today I drove this truck to job A, so I'm going to allocate 1 day's worth of depreciation to job A, right? That's a point of diminishing returns. You have interest expense, right? You take a line of credit out to finance the jobs, maybe purchase some job materials in advance. You have your IT infrastructure, right? You've got your project management software, you got your accounting software, you got your ERP software, a bunch of other softwares that are directly, utilized by your project manager, supers, and your entire team to do the job, right? So these are all indirect costs that you can say, yes, I have dollars going out the door, but I can't identify exactly which dollars those go to, right? So those are called indirect costs. So what you want, so when I go back and when you look at construction as a whole, construction is supposed to be full absorption, right? So my true gross margin for a project is the sum of my direct and my indirect costs. So it's very important. And let me give you an example of how that works. So let's talk about so what I recommend to everybody is come up with your indirect cost rate, right? And so you'll see this at your homework at the end of it. So what I tell clients is go, okay, let's see what your indirect cost is. So let's go look at what are all of our indirect costs that we incur, that we have to incur to produce our jobs. So let's say we have insurance at $50,000, depreciation at $25,000, interest at $2,500, IT costs at $15,000. They could be much more than that. And fuel, right? You're not going to allocate every gallon that you drive to a particular job. So these are good costs that are examples of direct cost or indirect cost, but they are job costs and they can be allocated to save you time. Does that make sense? All right. So let me show you how that's a factor, right? So if I go out and I say, all right, I have materials, all right, and then I have 10,000, labor of 5,000, subcontractors of 25,000. My total project cost is $40,000. Let's say I want to make a 20% gross margin on that. So that means my contract price has to be $50,000, right? So now I have a $50,000 contract price. I've got a $40,000 total project cost. I got gross profit of $10,000. All right. So I'm going out telling people, hey, I got gross profit of 20%. I'm making a 20% gross profit. But now let's go back and look at what costs we put into that gross profit. So we only put in materials. We only put in labor. We only put in subcontractors, right? Those are direct costs. We didn't include our direct cost. So now let's look at it. So this gross profit of 10%, I'm going to use my mouse. No, that's not working. So the gross profit of 10%, that I'm saying is a $10,000 that I'm saying is a 20% gross profit. But now I've got $2,500 in indirect cost. So my true profit on that job is $7,500. So my gross profit realized at the end of that job is 15%. Okay. But every business owner should do a break-even analysis based off their fixed costs to determine what gross margin they need to be able to meet their overhead, right? So now, if I go in and I say, okay, I'm going to include my direct cost and my indirect cost. So now I take the $2,500 and I add it to my $40,000. So now my total project cost is $42,500. I want to maintain a 20% gross profit. So now my contract price has to be $53,125 in order to maintain a true 20% gross margin, right? So if you're saying I'm only going to calculate direct cost into my jobs, then in this particular job, I lost $3,125 in revenue. Does that make sense? So that comes out of your pocket as a business owner. Okay, so it's very important that you take the time to understand what your indirect job costs are too, because they need to go into your estimates so you can include them in your contract price and get paid accordingly. Does that make sense? All right.
Can we ask questions now or should we wait till the end?
I don't care. What's the protocol?
You
Not
can.
okay. Yeah, I'll take a question now. Go ahead.
Okay. So, and this may come later on in the class, and I'm looking specifically at indirect costs, and I'm looking specifically at insurance. So as a construction company, I don't always know exactly what jobs I have. Let's say, for instance, I'm working for one client in a month. If I know I'm working for that one client, they pretty much get, I'm thinking that the cost of my insurance specifically or something like that would go to that one client. How do I assume what it is if I have multiple? One thing you said, and which is something that I want to do, is come up with a rate, an indirect rate. But how do you do that when you may have multiple jobs in a given month? Is that something you come up with real time, or is that a number that you can always use?
Well, that's a great question. So you start out, everything starts out with a budget, right? So you have your fixed costs. Okay. So you go, when you start a business, you say, okay, these are the fixed costs that I have to pay out just to open the doors. All right. So from there, I know that, so those are going to go into your indirect rate. So then you're going to say, okay, based off my first year, I'm going to budget, I could do $1 million. Okay. And you may not do $1 million. Okay. So if you get halfway through, so you're going to come up with an indirect rate based off $1 million. So you get halfway through the year and you're doing more than $1 million or less than $1 million, your cost will generally adjust accordingly, but you should be reviewing this indirect rate on a periodic basis. I would say once a quarter. Okay. And so to your point about how do you allocate it? So generally what we do is we pick a driver, right? You can pick labor, you can pick total project cost, you can pick revenue, just what makes the most sense for the business that you're running. I like total project cost. I think that is a very indicative driver of project activity, right? So if I've got 10 jobs going on, and I've got $2,500 in, indirect costs, let's break it down to a monthly, $120, right? Then I'm going to allocate that indirect cost on a pro rata basis to those jobs based off the cost that they incurred for that particular month. So you have the advantage of saying, okay, the month is over. Which jobs did I have activity off of? These were the indirect costs that I incurred during that month. Now I'm going to go back and allocate them on a pro rata basis to those jobs. All right. Now the indirect cost rate helps your estimate. Does that make sense? Okay. So allocating indirect cost and coming up with an indirect cost rate are two different things. All right. Your indirect cost rate is going to help you increase your contract price. Allocating the indirect cost is going to help you apply the cost to those jobs. Does that answer your question?
It absolutely does. And I was thinking more on the estimating side than I was on because I can figure it out easily after the month is over or after the job is over, because I can look at the period of time that it was and I can allocate funds. It's just when I'm estimating sometimes, I'm trying to figure out, okay, what should I put in here as far as indirect costs? But okay, cool. Thank you.
You good? Awesome. All right. So it's important. So you can see you would have given up $3,100 had you not included your indirect costs, right? So it's very important as a business owner. And I can tell you, it's the number one most missed opportunity. People love to tout a high gross margin. I would rather have a true gross margin, because then you can know what to work with in order to make adjustments going forward. Does that make sense? And the whole purpose is to evaluate your estimating process as you go through, not only for the job you just finished, but for the next job that you're bidding on too, right? Because sometimes, a lot of people say, well, I'm not going to include my indirect costs because I may lose the bid. Well, you're losing money too. So, you're doing work cheaper. So let's talk about, so one of the things that I always hear when it's common about indirect cost and job costing is, what about salaried employees? What about owners? What about project managers, estimators? What about accounting, right? That's a big one, right? As your company gets bigger, you've got a full-time bookkeeper. So let me ask you a question. When your accountant's sitting in the office processing all these accounting transactions, what do you think most of the transactions are related to? Projects, right? So wouldn't that really, because they are processing transactions related to a project, isn't that really a project cost, right? The project manager is spending his time to manage that job. Isn't that really a project cost, even though it's a fixed expense, right? Same with the owner, right? In a small business, owners wear multiple hats. You could be an estimator, you probably are. You're probably a project manager too, right? So when you're spending these times on those jobs, you should be allocating your costs and your time to those jobs to make sure that you get a true project cost. Because one day you're not going to be the project manager. You're going to be the company manager. And so you're still going to have to include those costs going forward. So all of these individuals are involved on every project in some capacity and should be allocated to jobs. As we talked about, the majority of the accounting department revolves around job costing, invoices to owners, paying vendors. And so a percentage of the accounting should be allocated to projects. And you don't have, project managers and owners for project related items should keep timesheets. All right. So we used to make everybody keep a timesheet. Everybody turns in a timesheet. They hated it, but they did it because that helped us get a true job cost picture. Estimators, right? They may estimate all jobs and may not be allocable to one job, but you want to allocate those to the jobs because it is, again, a true job cost. So what we do is, like for accounting, is we estimate, so 80% of the controller's time is probably spent on job cost. So I'm going to take 80% of the controller's time and I'm going to allocate it to the job cost. Now I may have a job cost accountant or an accounts payable clerk or a payroll clerk or a clerk that does accounts payable and payroll. And all they're doing is job function. So 100% of their cost should be allocated to jobs. Does that make sense? So we used to take our accounting department and say, okay, 80% of our accounting department is going to be an indirect cost, is going to get allocated to jobs. Because why? I didn't have a job cost accountant there if I didn't have a job, right? So I wouldn't have accrued her salary if I didn't have jobs. Does that make sense? So again, indirect costs include all the other stuff that we talked about, like the insurance and the depreciation and the IT costs and the interest on your line of credit, but they also include your salaried employees, your owners, project managers, estimators, and accountants, okay? Don't forget that. And then anybody else you may have in. Okay, so let's talk about estimate versus actual comparison, right? So every construction company is different. You've got some contractors that do labor intensive jobs that turn over in a couple of days or a week or a couple of weeks or a couple of months or a couple of years, right? So everybody's operating cycle is a little different. So the frequency in which you evaluate these estimate to actual comparisons depends on your business alone. So I'm going to kind of talk generally, right? So because everybody's going to be different. So the estimates should be compared periodically to actual cost. Again, the frequency is depending on the length of the job. Small labor intensive jobs should be reviewed daily or weekly, right? So if I've got a job that I go out there and I got 2 weeks to knock it out and it's mostly hourly with labor that's going out there, I'm going to be looking at that labor daily at a minimum, weekly at a minimum, but probably daily if I'm trying to manage it correctly. I'm sorry, I have my puppy here. She's all over me. So, well, just a second. Anyhow. Sorry about that. It's the benefit of being self-employed. I can bring my dog to work. All right. So you have to look and say, okay, now if I have a larger job, right? I've got a job that lasts 8 months. You know, looking at stuff weekly may not be beneficial, right? So I'm going to review my estimate to actual on a monthly basis. And so what does that mean? So when you do an estimate, you do a line by line, right? And again, we talked our estimate's going to basically mirror our job cost. So we're going to do a budget to actual on a line by line basis. Excuse me. So I'm going to say, okay, I estimated $10,000 for concrete. We spent $8,000 on concrete. Where did we save? Or are we done buying, right? Maybe we're not complete. Or if I estimated $10,000 for concrete and we spent $15,000 for concrete, why did we go over $5,000? Did we make a mistake? Did the owner ask us to do more work? Did we just, make a bad estimate, right? So we could have said, well, we estimated 10,000, but we were wrong. And it's really 15. That happens too. You know what I mean? So, and the variances should be investigated every time. So what it does is it provides strong points and opportunities for improvements on the current jobs and in the future jobs. And that's the whole purpose of the estimating and the job cost comparison and evaluating it at the end, right? All right, so let's talk about accounting methods for contractors. Now, again, every contractor is different and it all depends on your size. No, we're going to do a break after this one. That's all right. All right, so for the accounting methods for contractors, when you start out, day one, you're going to start out on the cash basis of accounting, right? How much money did I collect and how much money did I spend? That's going to be how you're basically going to evaluate your business. As you grow, right, then you're going to move to the accrual basis. It's easy when you're small to manage it on the cash basis, all right? But as you grow, you're going to start getting it on the accrual basis, and you're going to start recognizing receivables, and you're going to start recognizing payables, and then you're going to start doing accruals. And then, or you could do some hybrid version of modified accrual or modified cash accrual basis, right? So basically what that means is the modified cash accrual basis is probably what 75% of contractors use. So what every contract, I would recommend every contractor accrue accounts receivable, every contractor accrue accounts payable, and then your other prepaid expenses and accounts receivable, prepaid expenses and accrued expenses, you need to make that a judgment call based off the size, right? So if you're going to prepay $100,000 of insurance on day one, then maybe you want to put that on the balance sheet and amortize it over. But if it's only a $5,000 expense, it might be okay to go ahead and just expense it to the job and then just move on for sakes. Same with accruals, right? You're not going to stop and do a payroll accrual at the end of every month, because by the time you've done the accrual, you've already paid the next payroll cycle, right? So just go ahead and treat the payroll on the cash basis, right? And then that way you don't have to make an accounting nightmare for yourself. And then your big accruals are your accounts receivables and your accounts payables. But again, it just depends on your size as a contractor. But then you have completed contracts, the completed contract method, okay? And this is what home builders use. And this is what a lot of jobs that have shorter operating cycles use as well, right? So if my average operating cycle for a job is 3 weeks, then under the completed contract method, as I incur cost, I'm going to defer them on the balance sheet. As I bill my customer, I'm going to defer it on the liability side of the balance sheet. And once that job is complete, and I've incurred all my cost and I've built all my revenue, then I'm going to take them off the balance sheet and send them to the income statement, right? So that way, you know, at the end of the job, it doesn't hit the income statement until all the activity has been completed, and then you can recognize your gross profit at that point. And then as you get bigger, you have the percentage of completion method, which is now called the input method. So, and that is where you recognize your revenue as a percentage of your cost compared to your estimate. And so what happens is, as you grow, so the average life cycle of a contractor is different. So I'm going to generalize, right? So you start out your business, you're going to operate on the cash basis for probably your first $1 million, right? Then once you get past your first $1 million, you're going to go to the modified accrual basis, because your receivables and your payables are going to start getting bigger. They're going to start aging a little more, right? So then you get to $1 to $4 to $5 million. Then you need to make a decision. Okay, where are we going to start going to revenue recognition? And that just depends. It depends on your business and your operating cycle, but it also depends on the users of your financial statements. So once you get to a certain size, bonding agents and creditors and sureties like to see the percentage of completion. So once you become a big contractor, you're going to use the percentage of completion method. And it's really the best method, in my opinion, to use, because it's kind of like a full accrual method and shows you your earnings as you progress in a real-time basis, right? So where a completed contract to contrast on a completed contract method is, I can start a job in December and I'm going to incur all the cost in December, or most of the costs in December. And then in January, I'm going to do my billings, right? So I've incurred most of the activity in one period. I've done my billings in the next year, but I'm going to recognize all the activity in the income statement in the subsequent year when it's completed, right? So all this activity I may have done in 1 year, I'm not going to recognize until the subsequent year, right? So it kind of pushes that activity down. What the percentage of completion does is it smooths it out over time and lets you recognize revenue and gross profit on that job as it progresses. So let me show you some examples. So again, so what method is best to use? It depends what's best suited for your business. So the two most common are the completed contract and the percentage of completion. And I, as a consultant, would recommend that you pick one of these two, because it's the easiest way to completely match your revenues and your expenses to the results of that job, okay? Because some people will say, okay, I'm going to recognize my cost as I spend, and I'm going to recognize my revenue as I collect, right? But that's the cash basis. So I could incur all my expenses in December and not collect my income until January. So now my income statement looks really crazy, right? So at the end of 2021, if I did all this work on the job and incurred all the cost, my 2021 profit's going to look low. But then I turn around and bill it in January. So my 2022 profit's going to look high because all the costs for that job are in 2021, right? So that's why you want to go, okay, on the completed contract method, I'm going to defer all my billings and all my costs until the project is done and dump it down to the income statement where I can recognize all the margin when the project's complete. Now, again, the percentage of completion method is recognized when it's a progress measure on a cost-to-cost basis, measured from cost incurred to total estimated cost, and the percent is applied to contract price for the calculation of revenue. So at the beginning of the presentation, I said one of the differentiating factors for construction companies is that their revenue is not the result of a transaction like something you buy on Amazon. You buy something on Amazon for $100, Amazon recognizes $100 of revenue. In construction, it has to be a calculated amount. So let me show you. All right. So I wish I could, oh, okay. Can you all see my mouse? All right. So on the percentage of completion, we're going to start with our contract amount of $100,000. We're going to have total estimated costs of $90,000. That's going to give us a gross profit of $10,000. All right. That's what we're going to do on this total project. So let's say at the end of 2021, I incurred $45,000. I had $45,000 of cost incurred on that project, right? So that means I'm 50% complete because 45 is half of 90, right? So I'm going to take that 50% and I'm going to multiply it times my contract price of $100,000. And that means I've recognized revenue of $50,000. All right. I've incurred my $45,000 of cost, which leaves my gross profit of $5,000. Does that make sense? All right. So one of the neat features of the percentage of completion is you have over and under billings. All right. So, but just because you bill revenue in a construction company doesn't mean you recognize it, right? You buy something from Amazon, they bill you $100. They recognize $100 in revenue. In construction, if I bill $100, I just billed $100. It doesn't matter. It has no reflection on my revenue at all, because over here, we've showed you that the calculation of revenue is the revenue is a calculated amount and not the result of a transaction, right? So what happens is when you bill, the billing may not correlate to the revenue that you recognize. So best practice, when you start a job, you always want to bill ahead of time, right? You want to get bills out before cost. Why? Because you don't want to finance costs with your money. You always want to try to finance costs with their money, right? So you go ahead and say, okay, here's the job, here's a bill, give me some money, we'll get started, right? So the billing is a function of cash, where the revenue is a function of completion. So let's look at an example, right? So let's say on this particular project, at the end of the period, at the end of 2021, I'd incurred $45,000 in cost. But let's say I only billed $45,000, right? So I incurred $45,000 in cost and I billed $45,000, maybe because that's all they'd let me bill. But as we show over here, we recognize revenue of $50,000. Does that make sense? So we've billed 45, we've calculated our revenue at $50,000. So we have an underbilled amount of $5,000. Does that make sense? So that means that what underbilled amount represents is costs that we've incurred that we've not billed for. Does that make sense? Because if we had to bill for all the costs that we have incurred, we'd have billed the $50,000, because that's what we would have recognized. But again, don't confuse billing with revenue recognition on the percentage of completion. They are not the same thing like they are on an accrual basis. All right. Now let's look at it in an opposite manner. So if I have an overbill, so let's say that I billed them $55,000. All right. But we already saw that my revenue was 50,000, or we billed them 55, but my revenue was 50,000. So I've overbilled them 50,000 from what I've earned on that job. So that creates, I have to defer that billing on the balance sheet to reflect the true gross profit as we go. And I'll show you how it ends up on the financial statements. So if I have an underbilling amount, and you guys all got businesses, right? So you've all looked at your income statements before. You've all seen your revenue, your cost of sales, your expenses, and your net income. So I'm going to ask you to picture your income statement. So when I'm looking at my income statement, I see that my billings, let's go. My billings are $45,000. All right, so my billings were $45,000. So I was underbilled by $5,000. So what I'm going to do, and I'm going to talk a little accounting technical terms, debits and credits. All right. I'm going to credit my revenue in a separate account called an over/under adjustment. So you want to keep billings separate from revenue recognition. This is billings. This is billings. This is revenue recognition. All my billings are going to go to one account. Then the way that I'm going to true up my revenue is through an over/under adjustment account that's going to offset my balance sheet. All right. So let's look at it this way. So I am underbilled $5,000. That means I have done work that I have not billed for. So think of it as kind of like an accrual of work that you're going to bill for. All right. So what I'm going to do is I'm going to go put a $5,000 asset on my book, just like you would a receivable, right? So if I'm going to bill them $5,000, I would put a receivable on my books, and then I would recognize the billing. But because we're underbilled, doesn't mean we're not going to recognize the revenue. So I'm going to put a $5,000 asset on my book called construction in progress, AKA under billings. All right. And then I'm going to offset that with an increase to my over under adjustment account. So it's going to increase my billings to get my income statement to the $50,000 in revenue. Does that make sense? On the converse side, in an overbilling situation, all right. So in an overbilling situation, I would reduce the billings somewhat. Okay, yeah. So in an overbilling situation, all right. So in the overbilling situation, I billed $55,000, okay, but I'd overbilled it. So now I have to defer 5,000 of that to deferred revenue. And for construction, it's called advanced billings on contracts. So my billings account's going to show $55,000. I'm going to come through and adjust my income statement to reduce that billings by $5,000 to show revenue of $50,000. And I'm going to have a deferred revenue, an advanced billings on contract, and a liability. So as I make further progress of percentage of completion on that job, I'll pull it back into revenue. Does all of that make sense? No? Did I do it all right?
Nah, could you go back over that again?
Yeah. All right. So let's start over here. So in a percentage of completion, right?
Mhm.
So again, billings and cash aren't always going to line up. Okay. So if I have $100,000, let's go slow. If I have $100,000 of a contract amount, 90,000 in total estimated costs, my gross profit's going to be 10,000. At the end of the year, if I've incurred $45,000 in cost, I'm 50% complete, right? So we take that 50% and apply it to our contract price. That means I get to recognize revenue of $50,000. So my $50,000 of revenue recognized minus my total cost of $45,000 gives me $5,000 in gross profit. Does that make sense?
Yes.
Okay. So again, construction revenue is a calculated amount. Billing is a cash function. So we've billed $45,000 for this job, right? But we've on the underbilled scenario, we've billed $45,000. Maybe that's all they had let us. All right. But as we've seen over here, we've recognized revenue of $50,000. So we've underbilled our job by $5,000. We've incurred $5,000 more in costs than we've billed the customer for. All right. So we're going to, all right, before I go to the next slide. So in an overbilled situation, if our total billings were $55,000, again, our revenue was $50,000, then we have overbilled $5,000. Okay. So an underbilling represents an asset, and an overbilling represents a liability because I have billed more than I have earned. Does that make sense?
Yes.
Is that better? Okay. So when you get to the income statement, this is why I don't want you to confuse. So if I've billed $45,000, right, that's what it's going to show on my income statement, but that doesn't reflect the revenue that I've earned, right? Because every time you bill, you're going to increase accounts receivable and you're going to increase your income statement. Well, we've already said my billings is going to go to my income statement at 45,000, but my revenue is 50,000. So you have to make a manual adjustment to your income statement. You have to increase your revenue by $5,000 in your over under adjustment to get your total revenue to 50,000. So on your income statement, your revenue is reflected by your billings plus your over under adjustment, plus or minus. Does that make sense? And then you offset that with an asset. So if I'm underbilled, I've paid out more than I billed, then I'm due that money. So I'm going to book a construction in progress asset, which is basically like a receivable, which is going to increase my income statement to bring my total revenue to $50,000. Does that make sense?
Yes.
Okay. So in a converse situation, if I've overbilled, my income statement's going to show $55,000, but I didn't earn $55,000. I only earned $50,000. So I'm going to make an adjustment on my income statement to reduce my revenue by $5,000. So my total revenue is $5,000, $50,000. And when I reduce that, because I've overbilled, I've collected more money than I've earned, then I'm going to defer that $5,000 until I earn it. Does that make sense?
Yeah, so on the balance sheet under the liability, you have the advance bills, saying AKA overbilling.
Mhm.
So would that nominal value, why wouldn't it be negative 5,000? Just to indicate that you,
These are in and I apologize for that. These are in accounting format, like
okay,
debits and credits, so to speak. So I can only think like that from a number standpoint. So when you think about it, every time you recognize revenue, it's a credit. Okay.
Okay.
So in order to reduce a credit, you would have to do a debit, which is a positive. Does that make sense?
Yes, it does.
Okay.
I just
So-
got on kind of late, so.
Yeah, no problem, no problem. All right, so that's the biggest thing on the percentage of completion is the over under billings, and it'll all start making sense. So we talked about there's also billing. So if I'm a CPA and I do your tax return and I send you a bill for $500, then I'm going to debit my accounts receivable for $500 and I'm going to credit my billings for $50,000. So I'm going to increase my accounts receivable $500, increase my revenue $500. All right. In construction, it's a little different, right? So in construction, you have retainage. So at the end of the day, what a lot of companies do is they'll bill retainage as they bill it, right? So at the end of the job, they'll bill 90% of the job into their accounting system. And then once the job's complete and their retainage gets released, then they'll generate another invoice for retainage. And that's how 100% of the billings get on the books. That's not the accounting way to do it. Retainage is accrued on your books with every single invoice that you issue. All right. So let's say that I recognize or I issue a total invoice for $50,000. Okay. Does anybody use the AIA documents, the pay applications? Right. So if I'm using an AIA pay application, there's a line on there called completed and stored. That's the total amount that you completed and that you're billing, right? So I'm billing $50,000. All right. So that's completed and stored, but my current amount, the current amount that I'm billing is 45. That's the amount of money I want right now. And the $5,000 is the retainage, is the required 10% that I have to put into the end of the job. So as I issue that $50,000 invoice here, it's going to be broken down on my balance sheet between $45,000 in accounts receivable and $5,000 in retainage receivable. And my total invoice that's going to go to my income statement is going to be $50,000. So you see my billings is going to be $50,000, accounts receivable 45, and retainage is 5. So when I collect that $45,000, that $5,000 is going to sit out there till the end of the job. So this is the way that you have to, it's one way to track your retainage, but you're also required to recognize the retainage in your revenue and the calculated amount as you issue those bills. All right. And then at the end of the day, when you want that retainage doesn't go to the income statement when you bill it. Retainage is simply a reduction of retainage receivable, and you're moving it to accounts receivable. So that
Josh,
way, yeah.
I'm sorry, Josh, and if you could just explain retainage, I just don't want to take for granted that everybody is currently working through a situation with retainage.
Sure.
So just explain the retainage.
Absolutely. So retainage is, let's say that I hire you to come build a deck on my house. And I'm going to say, and you're going to go, all right, it's going to take me a month. It's a big deck. I don't have a big house, but it's a big deck. All right. So it's going to take you a month, and you're going to tell me I'm going to bill you weekly. All right. Because I got to pay my guys. All right. And I say, fine, that's a deal. Right. But how do I know that I'm going to pay you in full and the job's going to be done right? Right. Because if I pay you all the money, you could just take the money and say, I'm done, and walk off. And then now I've got to have recourse to the legal system, right? So what happens is I'll say, all right, here's what I'll do. I'll give you 90% of your money as you progress this job. And I'm going to hold 10% until the very end. And we're going to call this 10% retainage. I'm going to retain 10% of the contract price, 10% of the money that I pay you until the job's substantially complete. And then I'm going to go out there and look at it and say, yep, you did your job. Everything looks good. Punch list is done. It's cleaned up. Now I'm going to release the retainage. And then now you can have your money. Okay. So in a lot of contractors' case, it's their profit, right? So what happens is the contractor defers their profit. They get to pay their subs, pay their vendors, pay their labor, and then they get their profit once the job is over. So they withhold a certain amount from you, 10% of retainage. They retain it till the end of the job until it's complete, and then they release it. Is that okay, Joe?
No, you're absolutely right, because most of the clients who we deal with, airport, MARTA, GDOT, most public works contracts, you know, some more than others, as Josh has mentioned, requires a retainage, and it's very important, you know, that everything Josh is going over and will go over as it relates to construction financing is so important, because it helps you not only clearly communicate with your banker where you are, it also helps you to communicate with the surety company based on how you're performing and profitable. But most importantly, it helps you to justify your billings when you bill your owner or your client.
Yeah. Yeah.
Okay, can I just say, Josh, this has
Yeah.
really been good, because I probably do it wrong. When I put it into the cash app, the pay app for the GCs, I do it for a lot of GCs. I'm not a prime. So when I put it into the pay app, that's what I put into my system as like revenue. I realize the thing, but I don't do anything with the retainage. So I almost kind of work like a cash basis, but I really like this better because it really will make my balance sheet look better, because it'll show more receivable. Do you suggest I change it from accounts receivable, just don't put it in with my regular accounts receivable, and make it a sub account of accounts receivable called retainage receivable?
I do.
Awesome. Okay.
Absolutely did.
Thank
Okay.
you.
And so this is on the you sending bills to your customers, right? But you also pay your subcontractors too. So it's a domino effect, right? So if the owner is going to withhold 10% from you to make sure that you're doing your job correctly, then you're going to withhold 10% from your subcontractor to make sure he does his job correctly. So now so on the flip side of it, I'm getting payables from my vendors, right? I'm getting invoices from my subcontractors. So let's say that I got a $45,000 invoice from my subcontractor here, right? So I'm going to record that. It's a $45,000 invoice. So I'm going to hit accounts payable for $40,500. 10% of 45 is 4,500. So I'm going to hit retainage for 4,500. And I'm going to hit cost of goods sold for $45,000. All right. So so I get a $45,000 invoice, but I'm only going to pay $40,500 until that subcontractor is done with his job. And then at the end of the job, when he does everything right, and we're in agreement that we're come to conclusion, then I'm going to pay him his $4,500 of retainage. But I've already recognized that $4,500 into my job and my financials. Does that make sense? Okay, so I think we're kind of so basically what I wanted to do for the first part was just kind of differentiate some of the key differences between normal businesses and construction accounting. And it really boils down to, and I'll summarize before we go into our 10-minute break. So it really boils down to estimating accurately, including all your direct costs, all of your indirect cost. Then once you have your estimate accurate and you start the project, then you start job costing those costs in the same line item that you estimated it in. So you can compare the budget to the actual. So you make sure that you're staying within budget or you're not, okay? And then I wanted you to understand how revenue is calculated, that you have more than one option to recognize revenue within your business, depending on your size, depending on what makes sense for you. And then some differences in how the financial statements look regarding construction contractors versus normal businesses. No, Amazon doesn't have a retainage receivable or a retainage payable, right? That's strictly, to project or construction related accounting. So those are the main accounting functions, and the retainage and the indirect cost are probably two of the most common errors that I see in construction accounting when I'm going through and reviewing the books. People don't record retainage properly, and they're not including all of their indirect cost in their job cost, which is not the big deal, right? Because you're going to incur that cost either way. It's really coming up with an indirect overhead or indirect cost rate so you can make sure you get paid for your indirect costs, right? So those are kind of the summary factors that I wanted us all to understand. And then once we come back from our 10-minute break, I'm going to break down into some job schedules, show you some ratios, and then give you some best practices on how to move forward. Okay. So we'll take a 10-minute break and come back at 7:19. Is that okay?
Yes, that's fine. I have a question.
Yes,
Who
ma'am.
is Ms. Shantae? What company are you with? A Belinda? What company are you with? And a Miles Namor. Narmore.
Bryson Constructors, Beatrice and Linda.
Which one?
Bryson Constructors.
All three?
Beatrice,
Miles is also Bryson Construction.
Bryson, correct.
Belinda Bryson. Okay.
And Beatrice and Linda.
Beatrice.
The B
Hey,
stands for
Sean.
Beatrice.
Okay, I see a Shantae. SHAUNTE. I'm going to put you in the waiting room. All right, everybody take a break right now. Thank
Shantae's
you.
precise.
Oh, we're precise. Thank you very much.
You're welcome.
10-minute break.
Giving her classes, she's practically like crawling in my lap, trying to get me to throw the ball. I'm like, I'm working.
Put your mics on mute, please, everyone.
Hello. Hello.
Josh, can I ask you a question on break?
Fire away.
Okay, so, what's the difference in indirect cost and overhead?
Indirect cost is, again, an indirect cost is a cost that you expend to, that's a job cost that you cannot
Right.
clearly identify to a particular job.
Right,
Overhead is like rent.
okay,
Does that make sense?
yeah, okay,
Office
See-
supplies.
yeah, see, because I can make a written office supplies indirect, but of course, no. So I just wanted to be sure that my head was in the same place.
Mhm.
Just like indirect, it's easier for me to associate indirect cost with a job. Overhead is a little tougher.
Mhm. You don't want to allocate overhead to jobs. Under the
Okay, no,
accounting-
not to a job, but
Okay.
when I'm trying to figure out what kind of profit I have, I think early on in our estimating process, we didn't think about our overhead.
Ah,
And it is definitely a part of what we have to bill in order to,
yeah, absolutely. And so back into it, right? So, you kind of know what your overhead is. So come up with what your fixed costs are. You can estimate to what some of your variable costs are. And then, so you use your overhead to back into your gross margin. Okay. So,
yeah,
so this is the margin I've got to charge to A, cover my overhead, and B, put the amount of money I want in my pocket.
okay. Okay, sorry, that's what happens when you're in the office trying to do a call. The
No
phone,
problem.
who would be calling me? Okay, thank you.
Sure.
Yeah, Josh, this is really good.
Thank you, sir.
Yeah, this obviously, we're going to make sure that as the classes go on, this obviously ties into the bonding. Obviously, as you know, it ties into the banking. So, as we share with everyone, the workshops are just the beginning. We're going to provide them a wealth of information during the workshops, but after the class begins, then we're going to sit down with each and every business, go over all of the modules with them to make sure which systems they have in place, which systems they have to sharpen. And, so we look forward to, continue to work with you. And we shared with the students that once we complete the class and once everyone completes their intake forms and give us everything we need, then we will review it and provide additional consulting services as needed as well.
Awesome. Okay, so I think we're at our time.
Yep.
Is everybody back? We got started a little late, so I want to make sure that, we're respectful of everyone's time.
Great. Let's see. Beth, is Beth, are you back?
Guess not.
Yes, I'm back.
Oh,
Great.
there she
Beth,
is.
I think someone's in the waiting room. If you could check.
Already took them off.
Great. Thank you. All right, Josh, is back to you.
All right. So the accounting part stunk, right? So debits and credits are never any fun. So now we get to the fun stuff. We get to numbers, right? So let's talk about contract schedules, okay? Why is it not advancing? There we go. All right. So you have two kinds of contract schedules. You have your completed contract schedule, okay? Which shows, guess what? Your completed contract. So what I've done is I've given you an example completed contract schedule. So this was my total contract. This was my amount completed through 12/31/20. This was the amount that I recognized for the year ending 12/31/21. All right, so you have the prior contract plus the prior activity plus the current activity gives you the contract totals. All right, and the purpose of the completed contract schedule is to show the users of the financial statements, right? So when you have financial statements and you give them to a bonding company, again, Amazon's going to give them a balance sheet and an income statement. A construction company is going to give them a balance sheet, an income statement, and a completed contract schedule, because it shows them all the contracts they've completed during that year and how the activity and the results of the operations came out. And they're also going to give them a construction in progress schedule. All right, and this schedule shows, again, all of your construction contracts that are in progress at the end of the year, and basically shows the activity. So for this particular contract or schedule, so here's my contract amount, my total estimated cost, my total estimated gross profit. This is my revenue earned based off of the calculation of my total cost to date divided by my total estimated cost. This is the gross profit that I've earned. This is the total amount that I've billed. Now I look at where am I underbilled, contracts in progress, or overbilled, advanced billings. This is the revenue I've earned to date, the costs that I've incurred to date, and the gross profit, for the year, and the gross profit that I've earned for the year. So from this one schedule right here for my contracts in progress, I can tell how this job is progressing, right? So I look here and I say, okay, this job is overbilled. That's good. That's where I want to be. This job's overbilled. That's good. That's where I want to be. Remember, preference is overbilled. Now this job is underbilled. Why? So you don't want underbilled jobs. Most of the time when you have underbilled jobs, it's generally because the job just got started and you incur costs before you get your first bill out. But look at this job down here at the bottom. I got a $61,000 underbilling. If I'm the owner of the company and I'm looking at my contract schedule, I'm gonna go to that project manager and be like, why are you underbilled $61,000 on this job? That means we are financing the job. So if it's an underbilling situation, your business is financing the job. You don't want that. If it's an overbilling situation, that means your customer's financing the job. Well, it's their job. Why shouldn't they finance it, right? So these are the two main schedules that the users of the financial statements will look at. Now, on the face value, it just looks like a bunch of numbers, right? But what your bonding agent, your surety company, your banker, what they'll do is they'll take these numbers out and then they'll start running numbers. So let's kind of go into some of those. So one of the things that you can take away from this job schedule is the cash position of a job, right? So just because I may be overbilled on a job doesn't mean I'm cash positive on a job. So once you get your contract in progress schedule together, you want to take a few extra steps to analyze, say, okay, this is what it looks like in totality, right? So billings and cash aren't the same thing. So now let's look at it on a cash situation. So I always take these numbers and say, all right, let's look at each job. So we'll look at job 21004. So we've incurred cost of 1.1, we've billed 1.3. It shows we're overbilled by $527, right? On the face value of that says, great, we're overbilled. The owner's financing it. But I've got $500,000 in receivables, $500,000 in payables, which means I've only collected 851, but I've spent 893. So even though I'm overbilled $527 on this job, I'm cash negative $42,000. So now it's not a billing issue. Now it's a collection issue, right? So I don't know who chases collections in your company. We used to make the PMs do it because they had the relationships with the owners. So I would call it PM and say, yo, you're 42,000 negative on your job. We need some collections in, right? So this is a different schedule on how you can use your completed contracts, your in progress, and then mix in your AR and your AP on a project level to find out truly where you sit on your job. So when I'm looking at this company, I'm underbilled 30 grand, net 20 total, but I'm $42,000 in the hole net. right? So that means I'm financing the work. So that probably means your line of credit's increased. All right. So then you can also take these job schedules and you can do other things as well, right? So what you want to do is you always want to do a fade analysis on your projects, period over period, right? Because again, the goal was to do estimate to actual comparisons to make sure that our gross profit was trending towards what we estimated it to be. So let's say we start a job, and let's say we start job 21001, and at the end of our first year in business, right? So we started in 2021, and at the end of the year, we had a job for $100,000. We estimated it was going to cost us $90,000 for a $10,000 gross profit and a 10% gross margin. All right. So what the way that the in progress schedule works is these people, the users of the financial statements, these people look at your information and they say, okay, you're estimating the 10% gross profit. So you know what? I think you know what you're doing. Job's trending good. So we're going to give you a bond on your next job because everything looks good. Then they're going to come back at the end of 2022 and then they'll say, hey, remember that job that you told us was going to make 10% at the end of 2021? How did it come out at 2022? So then they're going to say, okay, now it's a completed, right? This is why we have an in progress schedule and a completed schedule. So now they're going to look at your completed contract and they're going to say, wow, it actually finished at $5,000. I mean, at 5%, it actually finished at 5% upon completion. While it was in progress, we thought we were going to make 10%. So we had a profit fade of 5% of gross margin. Why did we have a profit fade? Did we have cost overruns? Did we have weather delays that we couldn't recoup? Did we just make a business decision to eat a cost for an ongoing customer because they wanted us to, right? Why did my profit fade? All right, so let's look at job two. Job two, we were going to make 20%. It ended at 30%. We had a gain of 10%. So why did we have a profit gain of 10%? Did we cut labor hours? Did we not take as much manpower as we thought? Did we not need as much material as we thought? Or were we just kind of padding it? And sometimes that's the case too, right? So then we look at job three, again, we come back and we analyze it and we go, okay, we had a 1% profit gain. Now profit gain's always good, right? But a profit fade's not. So what happens is you are judged on your ability to estimate, right? So if you come back and you say, okay, I'm going to do 10% profit and it finishes at 5% profit, and that's the way it works out every time, then they're going to understand you have a problem with your estimating. Because if you're always having profit fades, it means you're not estimating your jobs properly. You don't have a handle on your jobs. Does that make sense? But if you have gains, maybe that's a good thing. Maybe, you got a good change order, or you finished early, or you got a bonus for some sort of completion. But that's okay because they always want to see more profit. So it's really important when you report your numbers to the users of the financial statements that you're as accurate as possible in your contracts in progress, because they're going to judge how you complete that project and they're going to hold you accountable. It truly does affect the credit and what you get. So if you come up and you say, hey, I need a bond for $5 million and I've got all these gross margins over here, and then they all end up much lower than what you told them they were going to end at, they're not going to give you a $5 million bond next time. A $5 million bond next time. They may only give you a $2.5 million bond, because what they have is a risk factor of $2.5 million, knowing that your projects are going to fade down, right? So it's very important that at the end of each period, when you're reporting these projects in progress, that you do a very, very good job of estimating those costs, because they're going to evaluate you. They're going to grade you on your ability to estimate upon the completion of that project. All right. But that's not the only reason, right? So if you're paying taxes on the percentage of completion and you overestimate or you underestimate your job, that's going to increase your revenue and you're going to end up paying overtax on a job that you may end up losing, or paying too much tax on a job you may end up losing money on, right? So you always want to make sure that estimate is as accurate as possible, so your creditors and the users of the financial statements have the best information available to them, and you're not overpaying in an income tax situation. Because while a lot of money looks great to have on paper, the IRS thinks it looks great too. All right. So, so that's basically how you analyze your jobs, right? So you lose your
Josh,
control. Yeah,
we have one hand up for Miss
I can't see it.
Sheila.
Go ahead.
Hi, Josh. Hi. This
Hi, how
is
are you?
really, I'm good. This is some real good information.
Thank
A
you.
question for you.
Yes, ma'am.
So the materials falls underneath direct costs.
Mm-hmm.
What would be your suggestion? Because, you know, the cost of materials are going up now, right?
Yes, ma'am.
And I'm bidding on projects currently. So how do I, you know, protect myself so that I'm not losing money? I'm bidding it, you know, I'm estimating the job correctly. Like, I don't even know like the percentage. Is there like,
No, what you have to do, so that's a contractual issue. You can't,
okay,
you can't control the inflation, right? You can't control
right,
supply and demand. All you can do is control your quantities, your estimate, because what you're really estimating is your quantities, right? And then
right,
the price is what the price is. So when you go to negotiate your contracts, and if you have volatile materials in your contract, you want to negotiate price escalation clauses in those contracts. So
okay,
the price for this material is only good for 30 days. If this contract doesn't get started and we can't purchase that material in 30 days, then we're going to reevaluate the cost of that material and adjust the contract accordingly. So remember, like the past 2 years in 2020 and 2021, when lumber was insane, right?
mhm,
So a lot of people got burned.
right,
Nobody, you know, it happened so fast. A lot of people didn't take the time to
mhm,
negotiate that into their contract prices, right? And I don't think a lot of people foresaw that coming, because what was crazy about the pandemic is when the entire world shut down, construction took off. And it blew everybody's mind, and we're like, what's going on, you know? But it really did. So, you know, nobody could have predicted that. So again, if you have volatile material situations, that's a
mhm.
contractual, not an estimating. Does that
Okay,
make sense?
okay, it does. Okay, thank you.
No, no problem.
That was a good suggestion, contractual, because I'm in metal.
Yeah.
And we all know what happened to metal after pandemic. It jumped 3, but what I do is I actually give them a deadline. So I don't make my estimates now for more than a couple of weeks because it's still pretty volatile.
Right.
But I'm gonna tell you that ticks off a lot of GCs. They seem like they don't understand it, but I'm just like,
But they do, they just
can't.
don't want to pay it.
yeah.
Yeah, absolutely. So to Josh's point, you're absolutely right. We saw this happen a lot with a lot of DBs and a lot of firms. So that's why everybody's putting in, you know, the actual pandemic clause, you know, the force majeure clauses. So all those things are contractual, because nobody expects you to, you know, pay for, you know, an embargo or some type of natural catastrophe or a pandemic. So yeah, that is contractual.
And I'll give you an example. You know, I had a client who was in drywall, right? And, you know, he did not foresee the cost of drywall and everything increasing like it did. And, you know, he lost a lot of money on his jobs because he didn't protect himself contractually. Okay. And then, so I'll give you some more advice on that. You know, when you're looking at a contractual thing, right? You can negotiate billing, right? Again, you always want to be overbilled. So try to negotiate billing as much as you can when you can. And you can also, depending on your trade and your customer and where you fall in the construction of the project, you can also negotiate early release or a partial early release of your retainage, right? So let's say that there's a project out there for a month and you're the grader. I mean, for a year, right? And you're a grader. So I'm the first person on the job. Why am I going to be the last person to get my profit? Why do I have to wait till the job is over before I get my money, right? So if I'm the grader, I'm going to be like, hey, once the slab's poured and you've got the walls up, looks like my job's done pretty well. So how about giving me my money so I can move on to the next job? So remember, it's negotiable, but it's got to be negotiated in the contract beforehand. Okay.
Right. And
One
we
last,
will,
oh,
Yes,
we
ma'am.
will be sharing that going forward, as Josh mentioned. And that's something we were talking about in DC last week with the DBE and federal contracts. So all federal contracts have a special provisions. And in that terms and conditions, the TNCs of that contract, it deals with Davis-Bacon wages. It deals with your actual certified payrolls. It deals with your prompt payment process. And most importantly, it clearly spells out your retainage. And like Josh said, some contracts will they will withhold 10% of the contract up until 50%. So once the project gets at 50%, they may, and sometimes it's negotiable, release partial, all of it, or what have you. That's why it's so important for you to keep the records, as Josh is showing, because you're going to have to show that justification for your retainage amounts as well in your pay applications.
Makes sense. All right. So the contract schedules, when I go in and I'm advising my owners about, every business has a hierarchy, right? And you start with the owner and you go down to the general manager or however it's structured, right? But I go in and I teach all of my owners to manage their company off of the contracts and progress schedule. All right. Or some combination of it. And if I'm an owner, all I want to see is like I said, I want to see my profit fades, my gains, my losses, and I want to see my cash position on each job. So from a 50,000 foot view as an owner, if all of those numbers look good, I'm going to move on to whatever other responsibilities I have, because it looks like the people below me are doing their jobs. Does that make sense? But if I have a bunch of fade, then I'm going to step in and be like, okay, what do we got going on here? Something's got to be done. So there's a lot of good information that you can take away from the contract schedules. And really, it's the basis. So, again, when Amazon, when somebody's going to go evaluate Amazon, they're going to look at their income statement and their balance sheet. When somebody's going to look at a contractor, the first place that they're going to go to is the job schedules, not the balance sheet or the income statement. Oh, well, everybody goes to the income statement first. Let me take that back. Everybody goes to the income statement first, then they're going to go to the job schedule and see how you got to the income statement. Does that make sense? All right, so now let's talk about financial reporting, right? So that's what accounting is all about. Everybody thinks accounting is all about the numbers, getting the numbers in there, but it doesn't matter how well you get the numbers in there if you can't get the numbers out to make meaningful use of the information. So financial reporting is probably the most important part of the accounting process, right? Because it tells the story. So again, when you're looking at contractors, how you're evaluated, right? You can look at all these fancy ratios. You can go into your accounting textbooks and, all of these, 10,000 ratios on how to analyze your business, right? But really, when you're looking at contractors, there's only a few that you need that are critical. So, and these are how the users of your financials evaluate your business as well. So the first thing they do, they look at your working capital. All right. So your working capital is defined as your current assets minus your current liabilities. All right. And they'll adjust for certain factors, right? Like if you have a related party receivable, they're not going to give you credit for that because it's a related party. They want true economic substance, right? Because a related party receivable could be as easily forgiven as it could be collected. So it may not be a true asset. So they discount it. So they want to look at your true working capital. So they're going to look at your cash, your receivables, maybe your prepaids, your construction in progress. Okay, so my current assets are $360,000, right? So then I'm going to come over here and say my current notes payable are 15, my accounts payable are 175. I got 25 of accrued expenses. I've overbilled $100,000. My total liabilities are 315. So that means my working capital is $45,000. Positive working capital is always the key and the more, the better, okay? But they'll go in and adjust. So let's say in this contract receivables, you've got $50,000 that's been out there for 6 months for a problem job. Well, they're not going to give you credit for that. And now your working capital may go negative, right? So it's very important that you maintain a strong adjusted working capital, because that is what they evaluate you on. The other one is the equity. So the retained earnings in the business, right? So, and again, rules of thumb, every surety, every bonding agent is different, but a rule of thumb is you'll get a per project bonding of 10 times your working capital and a bonding program of 10 times your equity, okay? So your equity will need to grow with the business. Contractors are notorious for taking all the cash out of the businesses, right? But in order to get that bonding program that you may need to get the next contract, you may have to leave some equity in there, and you should always talk with your bonding agent before, you know, you go pull a bunch of money out. So I'll have clients call me up and they'll be like, hey, Josh, how much money can I take out of my company? And I say, well, from a tax basis standpoint, you can pull out this much and not be penalized from a tax standpoint. But I would call your bonding agent and have a conversation with him and see what your upcoming bonding needs are, to see what they want to see that equity as and working capital as, to be able to extend you the credit you need, because you don't want to take too much money out to where you hurt yourself for your next job. Does that make sense? So your main two, and you could go return on assets, return on equity. I don't think any of that matters in my opinion. I look at working capital and I look at equity. And then I also look at net income, right? How much money at the end of the day do I get to keep? And then you look at gross margin. So let's look at some ratios, right? So the ratio formula. So again, so you from a balance sheet standpoint, you're looking at working capital and retained earnings. So from an income statement standpoint, you're looking at gross profit. That's your number one measure of success. All right. Not only is it your gross profit for your company, is it positive? Yes. Is that good? Maybe, right? If you're a plumber and you're only earning 5% gross profit and every other plumber in the world's earning 20, what you doing wrong? Are you not estimating? Are you not bidding? Or are you working too hard and spending frivolously, right? So you always want to look at your gross profit, okay? And how does it fit within your particular trade? And again, you always want to look at, if I have a completed contract for 5, then I made 5% on, and I've got a similar contract that I'm estimating 10%, am I really going to make 10%? Well, because on the last one, I just made 5. You very well may, but past performance is typically indicative of future performance, okay? The next one is your net income percentage, all right? Or you could also look at, you know, your general and administrative to your revenue. Both of those kind of come down. If you're dropping a 5% net income to revenue, that's pretty good in any business, all right? And then your G&A to revenue depends on how big you are. In your first couple of years of operation, it could be a very big percentage, right? Because, you know, you may have to hire somebody full-time until you grow, right? But as you generally grow and stabilize, the G&A to revenue percentage will stabilize, and they'll kind of monitor that as well. Another very important one, and then you'll get this from the job schedule as well. Let's go back to the completed contract schedule, is your backlog. All right, anybody heard that term before? So your backlog is the work you haven't finished yet, right? And it's very easily calculated. So you take your backlog by taking your total contract amount and you subtract the total revenue that you've earned to date, and that's how much backlog you have. All right. So if I say, all right, I've got total contracts of 2.7 million. I've earned to date 2.4 million. I've got $244,000 of backlog. Is that good? I don't know, right? So what I'm going to do is I'm going to take that number and I'm going to turn it into a ratio. And now what I like to do is months of revenue backlog. All right. So I'm going to take my revenue backlog, which I just showed you of 244, and see what my average monthly revenue is. Okay. So and then see what my months of revenue backlog is. All right. If $244,000 means I've only got 1 month of backlog, that might be a problem, right? If $244,000 represents 3 months worth of backlog, that might not be a problem. It just depends on what your sales cycle is, right? You know, some contracts take months, years, weeks to get. Others sales cycles are closed much more quickly, right? So I always look at months of revenue to gauge how ahead of the game am I, right? So revenue as a number, backlog as a number in itself doesn't paint the whole picture. You could have a $20 million backlog, but if you're a $1 billion company, that might not mean anything, right? So then I also look at months of gross profit and backlog too. And you may say, why, right? Because even though revenue is great and kind of drives the machine, the company forward, the gross margin is the money that's coming into the bank account, right, from the results of the jobs. So I could have a high revenue backlog, but if I've got low margin jobs, I may not have enough gross profit to cover my fixed costs. Virginia, kind of like we were talking about earlier, I've got my overhead, my SG&A. Do I have enough gross profit backlog? How many months can I cover my overhead before I need my next job? Does that make sense? So I always look at my gross profit, always look at my net income, manage your G&A, and then I always look at my months and months of revenue backlog and months of gross profit backlog. To me, those are the most important, and how we're doing as we're just driving a car, right? There's a bunch of different things that you can use to drive your car: tachometer, odometer, how's the oil pressure, radiator, windshield wiper fluid. But at the end of the day, I'm just making sure I'm in between the two lines and my speed limit's going right. I'm at the right speed limit and I got gas in the tank. That's basically what these are telling you. Does that make sense? All right. So now let's talk about best practices. All right. So again, do them if you can. Again, everything is a cost benefit analysis. You don't want to create a process that you don't get benefit from. All right. Again, the goal is real time. All vendor invoices to be recorded daily, right? If I'm only recording vendor invoices once a week, I'm not even close to real time, right? If you're the owner and you come up and you want to look at how that job's doing, you want to make sure that the report you pull up has the most accurate information in it. So when I was a controller, I would tell the AP clerk, before you leave at the end of every day, the most important thing you do is to make sure that all the invoices are recorded into the system, so the users of that financial information have the most accurate information. Owner invoices are recorded upon issuance, right? Most subcontractors issue them on the 25th of each month. They should go into accounts receivable on the 25th of each month. General contractors generally do it around the 5th of each month. So they should go in as soon as you backdate those, right? But as soon as they're issued, you put them into the accounting system. No need to delay. Another good, and this is what, once companies become successful, they don't always know the right things to do. And one of the biggest things that I find is companies don't conduct job cost meetings. A job cost meeting is probably the single most productive thing you can do in your company to make sure that the company's financially accurate, the jobs are getting done, and everyone in the company is on the same page. So a job cost meeting goes like this. You pick one day a month. So on the 25th or the 20th of every month, the owner, the director of operations, the controller, the bookkeeper, whatever fits your organization is going to get into a conference room, and each project manager is going to come in and go over their estimate to actual with the owner and the accountant and talk about the job. It is an excellent opportunity for the project manager to understand how they fit into the grand scheme of things. I've given courses to project managers before about how your function in this company goes all the way from the project to the owner into the pocket of your boss. So in every decision a project manager makes, affects the owner's pocket. So if you are the owner, I encourage all of my owners to go to those job cost meetings and sit there with the project managers and the accountants and talk about it. And what are you going to talk about? You're going to do the budget to actual. Or how are you billed on your job? Are you overbilled? Are you underbilled? What's the cash position, right? Your project manager has to understand all of these aspects of the job to be able to keep the project moving forward. And most importantly, keeping cash coming in the door. That's the whole purpose of what we're doing, is to get cash coming in the door. All right. So do job cost meetings once a month, talk about your fades, your gains. All right. That's just the financial impact that you can get out of those meetings. There's also an operational impact. If I'm the owner, I'm probably the most experienced guy in the company, right? Person. I'm probably the most experienced person in the company. So if I'm sitting there in a job cost meeting discussing financials with a project manager, I could say, so we had a cost overrun over here. Why did we have a cost overrun? Well, the project manager is going to reply, we had a cost overrun because of X, Y, Z. And with my experience, I could say, well, I understand, but if you would have done this, or if you do this, we could get to a better result. All right. So it gives everybody an opportunity to learn, to grow, and be accountable within the system. Conduct post-mortem job cost meetings. Okay. The job's over. It's done. Okay. The job cost meeting as the job's going is to discuss the progress of the job. The post-mortem job cost meeting is to say, okay, the job's over. What did we do right? What did we do wrong? What can we do better? That's generally an operational thing, not an accounting thing, right? Reconcile your cash and your credit card accounts monthly. All right. You know, as you come in, record all your invoices, all your vendor invoices, your credit card receipts, record your credit card transactions off the credit card receipts, not the feed from the credit card company or the bank, right? Because, like, I'll give you an example. If I have an American Express bill for $10,000 and I just code all those charges to American Express, IRS is not going to come in and care that you spent $10,000 to American Express, because they can't prove how that $10,000 was spent. It has to be an individual detail. So for your credit cards, record those at the receipt level, not at the credit card statement level. Okay.
Quick question on that, Josh. Quick
Yes.
question. How is it looked upon on charging the customer the credit card fee? And how is that handled in the GL and overall as far as accounting costs?
Define credit card fee. That can mean a couple of different things.
So anytime any customer runs a credit card, we charge them back the 3% fee that we're charged.
Yeah.
And make it part of the overall spend. So how do you handle that?
The way that I do that in my business as well. So the way that I do that is you charge them a 3% because you get charged a 3%. So what happens is your 3% is going to be bank fees. And then what I do is I have a general ledger account that says bank fees. And then I also have a general ledger account that says credit card charges, and I net them. Does that make sense?
Yeah. One other question.
Yep.
It has been pitched to me about, especially dealing with government contracts, to be able to do level 3 credit card processing. Is that what you've seen in your years of experience, that it gives an edge to a contractor or not? Have you heard of that?
I'd have to defer that to Joe. That's more of a kind of a operational thing. Joe deals in more of the federal contract area than I do.
Okay.
I'm sorry.
All right. Thank you.
Yeah.
Yeah, you're absolutely right.
So,
You know, the number one thing is you want to know how your customer is going to pay you, right? So yeah. So based on how go ahead, I'm sorry.
No, level 3, are you referring to the level 3 credit card processing, Joe?
Yes. So
it was pitched to me by a company that it is best for federal contracts, when I accept credit cards, to use level 3 credit card processing. Is that a big deal on federal contracts? I mean, what it does is get down to the invoice level to be able to pinpoint that and directly connect it to the budget for the federal government.
Yeah,
Is that-
absolutely. Yeah, you're right. So, and then again, I think it depends on your agency. So depending on the agency you're dealing with, some are more, heavily, focused on credit cards than others. I know a lot of the DOT, and I've done work with them subcontracting a lot of ways. Some of them use P cards, et cetera.
Right.
You want to find out exactly, what your agency, how they're invoicing, and yeah, absolutely follow it and make sure if there's cost incurred with that, you make sure you factor that in as well in your estimating.
Exactly. Thank you. I appreciate
Yeah.
that feedback.
No problem.
Okay. All right. So more best practices. Perform a hard close every month. Treat every month like a year end. Reconcile every credit or every bank account, every credit card account. Go through your balance sheet, make sure everything, all your receivables are recorded, your payables are recorded. Go through job costs, make sure you've got all your job costs entered in. Make sure you got all your owner, customer invoices out. A hard close every month trues up your balance sheet and your income statement because that gives you the most accurate financial picture of the month. And the most important part of doing a hard close every month is a matching, right? You don't want to have expenses that you've incurred in one month get recognized in a different month. So if you do a hard close every month and make sure you match all the activity that you incurred within that month, get recognized within that month. So now you have an accurate picture of that month, okay? So perform and review project and company analytics should be done by accounting and with company management. Let me see my track. Okay, so what I tell people is, you have all this information, right? You should sit down and you should talk about it. So just like the job cost meeting, you're going to sit down and you're going to do a budget to actual on the job, and you're going to talk about financial performance on the job. You're going to talk about operational performance on the job. You need to do the same thing with your financial statements too. Sit down with the owner of the company and the accountant and go, this is how we did for the period. This was our gross profit. This was our net income percentage. And then if I'm the owner, and the project managers and everybody's in charge of the operational cost, I'm going to make the accountant do a budget to actual on the SG&A cost. So now you're sitting down and saying, okay, this is my budget to actual on the SG&A as well. So go down and make the owner. And if you got to go into his office and shut the door, or her office, shut the door and go over the financial statements and evaluate that performance, because what good is it? It's like writing a book. If nobody reads it, it doesn't matter, right? So if you're going to go through and you're going to put forth all the effort to do all of these things, sit down and get the benefit out of the information that you gathered. So that way you can make good decisions going forward. Routine transactions. A lot of people, don't know this. Do your deposits every day. There's no reason to let checks collect in a desk and deposit them at the end of the week. Most people got scanners. I want cash in that bank as often as it can be. I don't want to wait. I got my job as a controller because a customer called the owner of the construction company one day because the project manager called him and yelled at him because he hadn't paid him. And the owner called the owner called my boss and said, hey, I paid you 6 weeks ago. Why am I getting yelled at for not paying you? Well, then the boss goes into the controller's office. Well, the controller had a $500,000 check that had sitting in a drawer for 6 weeks. That's insane. Deposits go in daily. Checks to vendors weekly. You don't have to kill yourself writing a check every time somebody asks for it. Say, I write checks every Friday. There you go. There's always exceptions to the rules, right? Record payroll as it happens. Remit your payroll taxes the day you submit your direct deposit for payroll. You get 4 or 5 days, but there's no reason to wait. Go ahead and get it over with. Send it to the government, because late payments on payroll taxes could be up to $3,000 on your first offense, right? So don't mess around with payroll taxes. Record your fixed assets, record your notes payables, adjust your notes based off your payments between interest and principal, allocate your indirect costs, and prepare your financial statements again, and go over it. So what I like to do is I like to give us schedules, right? So go to your company and say, this is my hard close schedule every month. Reconcile the bank accounts, the credit cards, review the accounts receivable and all the fixed assets by the 5th of the month. I'm going to go through and make sure I've got all my indirect costs and everything allocated to the job cost by the 10th of the month. then I make the project managers turn in the estimates. Nobody can give you a better estimate on that project better than the project manager. So I get all of my estimates from the project manager. I'll tell you a little story. So I was auditing in a company down in Mobile, Alabama one time. And I go in and I get this beautiful set of financial statements to audit. And I get the job schedule. The first place I told you I go to is the job schedule. So I go to the job schedule and I'm sitting there with the CFO of the company and we're going over the job schedule. And I said, man, it looks like you guys had a great year. I said, so let's talk about it. And he's like, oh, we had a great year, you know? And so we started talking about it and we started talking about the jobs and the estimates. And I go, well, who did these estimates? And he goes, well, I did. I go, you did them? He goes, yeah. I go, well, you sit in this office all day. You've never built anything in your life. How do you know that these estimates are correct? And he goes, well, because, you know, I talked with the general manager and blah, blah, blah. And I said, oh, okay. I said, here's what I want. I want the general manager to go through and give me updated estimates for every one of these jobs. And then we'll see how it finds out. So when I got the audit report, but the financial statements before I started auditing it, they were showing profit of $1 million. I made the general manager go back and update every one of those estimates. And when he was done, the company lost $5 million that year. That's a true story. They were out of business and bankrupt 3 years later. All right. So don't let somebody sitting in an office who's never swung a hammer in their life give you an estimate on where that job's sitting. It's got to be from the people in the field, the people running that job. Hold job cost meetings. I can't tell you a more powerful thing that you can do in your company for the benefit of it than to sit there with your owners, your project managers, and your accountants and go line by line for the cost detail of the jobs. Financial issues to management by the 20th of the month, and then review those financials by the end of the 25th of the month. And you can compress, I wouldn't say expand, but you can compress the schedule as you need to based off your business. And if you get things done quicker, great. If you can do everything by the 15th or the 10th of the month, good for you. You can move on to the next month faster. A lot of my larger general contractors, this is the basic schedule that they kind of follow on a monthly basis. But make sure that you have a schedule, you have a routine, and you follow it every month because it's the only way not to lose control. So what I tell clients is if you lose control on a 30-day period, you only have 30 days to go back and figure out what went wrong. If you don't do these things you do them every 4 months or 6 months, or maybe once a year, and something happens or mistakes happen, now you've got 12 or 4 months worth of data to go back to fix a problem. It's much easier to fix problems 1 month at a time. And not only fixing them if they happen inside, but also catch them on the jobs too. So you want to make sure that all the financial information is correct as we go. So what I want to do is I want to give you some resources. All right. So I know a lot of you do federal contracts, and that's great. I don't deal much with federal contracts, but I'm a member of a couple. So here's some construction organizations. It's the Construction Financial Management Association, the website cfma.org. It is it's a national organization. I've been president for the past 2 years. I've been on the board for seems like forever now. And it is all of the major contractors in Atlanta and Georgia meet right down the road from my office once a month and do educational work, whether that's lien waivers, contracts, labor, financial, taxes. We put on 9 meetings a year, and it's purely construction accounting related. It's fantastic organization. You know, if you'd like, we have a conference on November the 9th. It's a 1-day conference. We have an economist come in and speak about the construction industry, how it works in Atlanta. This year, we're having a former FBI agent come in to talk about construction fraud. We always do a construction tax update. We generally do something insurance or technology related. We have vendors. all these kind of service professionals that service construction industry are there. So it's a tremendous networking opportunity for contractors, subcontractors, general contractors, attorneys, bankers, insurance agents, and CPAs, right? And it's extremely educated. It's only $150 for one day. It's very affordable. There's also the Associated Builders and Contractors. And there's also the Association of General Contractors. And these are all large national construction organizations that are strictly not-for-profit organizations dedicated to educating construction professionals. And I've been in some capacity involved in every one of them. I've just chosen CFMA to go for the long run, and they're fabulous, fabulous learning opportunities. And then let's see. So I think I ran just a little bit over. We started a little bit late. I'll be respectful of everybody's time and stop it right there and say, any more questions? Excellent. If you do, my email address is there. I got a deadline in 2 weeks, so I might not respond promptly. Bear with me, but I will respond. So if after going back, reading the materials or reading the PowerPoint slide, if you have some questions, let me know. I'll be happy to help you out. I love helping people out before they make mistakes. I'm going to bill you after you make the mistake, but I'll give you some free advice, before you make it. So, but I appreciate everybody's time. Thank you for listening to me, ramble on for a couple of hours. You've been a wonderful audience, and I hope everyone has a nice evening.
Great. Josh, I want to personally say thank you very much on behalf of the Mid-South Atlantic SPTRC. Thank you very much. I mean, obviously, in our partnership with the Bonding Surety Fidelity Association of America, they really recommend that we definitely get a construction accountant. So obviously, we'll make sure that they know you're just not an accountant, but you're the president of the local chapter here. I was interested in going to the November 9th deal until you said the FBI. So
he's retired. He's retired.
Okay, there you go. I'll make sure. But at the end of the day, ladies and gentlemen, thank you all very much. Before I turn it back over to Beth, Josh, once again, thank you. We'll be following up with you with the evaluations and any, questions that we have. We'll reach out and hopefully you can respond. And then, like I said, once we complete, the workshops, then we start the prescriptive plan. So as we meet with each and every one of you one-on-one, depending on, your company's needs, we will provide additional resources. So this is exactly what we mean by we want you to be able to successfully manage a project. And what you heard tonight, and I've been in business for 35 years. I live and die from the P&L statement and the income statement before, my team would go out and whatever they do, if I didn't know basically how to estimate the job, how to manage the books, and then how to meet with my team on a monthly basis so we can measure, our shortcomings and where we need to invoice, manage our businesses, would not have been successful. So what you heard tonight is clearly the keys to your success. So with that said and done, I'll turn it over to Beth. We look forward to joining you with the remaining classes. Beth Barner, take it away.
Okay, Josh, could you end your screen share?
Yes.
And I'll share my screen, please. That was great. We had great questions. And now I will share my screen. Let's make sure I go to the PowerPoint. There we go.
I'm going to log off. I hope everyone has a nice evening.
Okay, Josh.
Yeah.
I'm sorry. And Beth, Josh has already turned in his homework assignment, right? For the questions.
Josh, the questions, where are they?
Oh, so the only, I know Beth wanted me, I didn't have time to do more homework assignments.
I have one question. He says it takes about 30 minutes. This one, he's going to send us 3 more. The homework assignment is on, do you guys see the screen?
I can see it, yeah. What's your indirect rate?
What is your indirect cost rate?
Yeah, go figure it out, put it in your estimates, and don't give away any more money.
There you go.
So we have that one. And you email that to me, and I will have sent it over to Mr. Josh. And he will review them and get back with everyone on their homework. Our next session is October the 4th. It will be the Module 3, Bonding and Insurance. And the action items, again, is the homework assignment is due from today for next class period. I have not gotten all the homework assignments from last class period. Please email those to me for safety. I have a few client intake forms outstanding, only a couple, and I need the photo. Okay, I'm sorry. I'm supposed to have it on view. And the survey in the chat, I placed the link there that you guys can, you women and men, can complete it. Let us know. That's how we gauge our performance and to satisfy your expectations and needs. Thank you very much for joining. First, any more questions? Any questions of us? We will have a binder for you with all of the presentations that's from the whole program, and will be emailed to you. Right, Joe?
Yep. And let me tell you all why that's so important. The information you're getting, and you clearly see you're getting a wealth of information. So at the end of the workshops, leading into the certificate of completion celebration. Oh, by the way, November 15th, we're going to have 3 leaders from the USDOT in Washington. They will be at our closing ceremony on the 15th. So we want to make sure that we have a requirement to make sure that everyone participates. Beth is doing roll calls. So at the end of the workshops, for those who clearly have completed the sessions, we will give each company a binder. And the binder will have additional resources and all of the actual presentation decks that you've seen with additional information in, so we can begin to review your assessment and to begin to work on your intake and your prescriptive analysis. So that's what, once again, we're doing. This is just not a workshop and we send you a presentation. You will see, and I've been to many business schools and executive programs, this is exactly what you will get at the end of the workshop. You will get a professional binder with your company information in there and all the presentations, and what that binder will do when we meet with you for one-on-ones. We will use that to help us to create your analysis and provide you with prescriptive resources. So just wanted to make sure that I know everyone's eager to get the information. That's why I take good notes. But trust me, for those who complete, and I'm sure we will have a great success rate of completers, we have a method to this madness. We want you to be successful. And what a lot of our alumni have done over the years, I mean, I hear them all over the country, they still have their binders in their office, and believe you me, go back to it for best practices and resources. And the same thing for me. I have all my law books here. I have all my, binders here, and I go back to resources.
Jay Welch has his hands up. Jay?
Yeah, quick question. From what I understood when I joined the meeting, it said that it was being recorded. Is there a way to get access to the recordings as well? I mean, because the binders are great. That context, the conversation and the questions being asked and the communication is really helpful.
Good, very good question. As a matter of fact, we will send you the Greater Atlanta Economic Alliance, who manages the grant for the USDOT program. We have a website. I'll give it to you now. It's called accessconf.com. And when you go to that website, you will see a lot of our webinars in our previous bonding education program. So if you want to also just be a sharper student and get our,
Absolutely.
story, you never know, Beth has a lot of surprises up her sleeve. You can also look at that Access Conf to refresh yourself with other webinars as well. So Jay, very good question. We will be archiving at the end of the program. We will be archiving all of our webinars basically on the Access Conf. So what it will say Atlanta Bonding Education Program. It'll have a series of the class, and then we'll also have the names of the companies who completed the program.
Okay. I'm sorry, one last thing. You said it's Access Conf, C-O-N.
ACC is ACCESSCONF, conf,
Yes.
abbreviation conference
Dot-
.com.
Okay, great. Thank you. Thank you.
And you can go there and look at things from the past webinars, topics, things of that nature from bonded education and other topics also.
Okay, great. Thank you.
Access
Great.
to Capital is a reservoir of our webinars, conferences, speakers. And we had another question. Who was that? Anyone else? Okay. We want you to please go to your chat and click on that link. If you just click on it, and you can complete the survey at that time. Okay. And tomorrow I will always send it, but right then you can do it while it's fresh on your mind. Any more questions? Okay. I have a
Thank
question in
you.
chat. One question in chat. Great class. Everyone, enjoy your evening. Okay. All right. Thank you, guys. This was
Great.
great and very
Good night,
good.
everyone. Have a good evening. Bye now.
Interactive.
Bye now. Thank you.
Bye-bye. Email me the homework. That's it. Bye-bye. Let's mute myself.